The IRS doesn't retire when you do. The moment you stop working, 8 financial traps activate. Traps disguised as smart upgrades, sold to you by people who don't pay your tax bill. Most retirees walk straight into them. Here's what they don't want you to know. Before I go through all 8, you need to understand the mechanism underneath all of them. Because the problem is never the upgrade itself. The problem is what you have to do with your money to pay for the upgrade, and what that does to your tax situation. When you were working, your income was predictable. W-2 wages, maybe a bonus. Your tax bracket was fixed. The IRS knew exactly what you owed, and your employer withheld it automatically. The moment you retire, something fundamental shifts. Your income is now self-assembled. You choose how much to pull from the IRA. You choose when to take Social Security. You choose whether to sell investments. You control the timing of almost every dollar that hits your tax return. That control is the most valuable financial asset you have in retirement. More valuable than your IRA balance. More valuable than your pension, because how you sequence your income determines how much of it the IRS takes. The retirement dream home. You spent 35 years in the house that made sense for raising children, commuting to work, living within a budget. Now the kids are gone. You are retired. You want the house you actually want, the waterfront property, the golf course community, the mountain view. You've earned it. Here's what the IRS sees when you make that purchase. The median retirement dream home upgrade costs $187,000 more than the home being sold after accounting for moving costs, closing costs, and the price differential. Most retirees do not have $187,000 sitting in a savings account. They pull it from the IRA. A $187,000 IRA withdrawal in a single tax year is a catastrophic tax event for most retirees. Meet Robert and Linda, both 64. Robert has a pension of $42,000. They collect $31,000 combined in Social Security. They have $610,000 in a traditional IRA. They want to upgrade from their $320,000 home to a $490,000 waterfront property. The gap after selling their home plus closing costs is $193,000. They pull $193,000 from the IRA. That year, their total income is $42,000 pension plus $31,000 Social Security plus $193,000 IRA withdrawal. Gross income, $266,000. Their provisional income calculation now pushes 85% of their Social Security into taxable territory. Their IRA withdrawal alone pushes them into the 24% federal bracket. Their modified adjusted gross income crosses $212,000, the IRMA threshold. Their Medicare Part B premium jumps from $180 per person per month to $259 per person per month. That is $1,176 extra in Medicare premiums the following year. Their federal income tax bill that year, approximately the $43,700 in a single year. On a purchase they thought was just a real estate transaction. And the IRMA surcharge, because of the 2-year look back, follows them for 12 months after that. So the dream home costs $193,000 out of the IRA plus $43,700 in federal income tax plus $1,776 in elevated Medicare premiums. Total real cost of the upgrade, $238,476 SPO, not $193,000, $238,476. The IRS collected $45,176 on Robert and Linda's dream, and they never sent a single warning. The retirement car, you drove sensible cars your entire working life, Camry, Accord, F-150. You told yourself when you retired you were getting the car you actually wanted. Mercedes, BMW, Cadillac Escalade, the lease that finally makes sense because you are not commuting anymore. Here is the trap inside the car decision that has nothing to do with depreciation. Most retirees pay for a retirement vehicle one of 3 ways. They pull from the IRA, they pull from a brokerage account and sell appreciated stock, or they lease and add a fixed monthly obligation to their budget permanently. All 3 are IRS events. An $82,000 luxury vehicle purchased with IRA funds in year 1 of retirement creates an $82,000 taxable withdrawal. On top of pension and Social Security income, that withdrawal almost certainly triggers IRMA surcharges 2 years later. It pushes 85% of Social Security into taxable territory, and it permanently reduces the IRA balance, which means less compounding over the next 20 years and a smaller cushion against RMD-driven tax spikes at 73. Take Barbara, age 63, pension of $38,000, Social Security of $22,000, IRA of $520,000. She pulls $78,000 from the IRA to buy a fully loaded Cadillac Escalade. That year, her income is $138,000. Her IRMA threshold is crossed. Her Medicare premium spikes at $65. Her federal tax bill on that withdrawal at a blended rate, approximately $17,200. The Escalade did not cost $78,000, it cost $95,200 after federal income tax. And the $78,000 that left the IRA at 5% annual growth over 20 years would have become $207,000. Barbara spent $207,000 in future IRA wealth on a car that will be worth $24,000 in 10 years. The IRS did not stop her. They processed the withdrawal, collected their $17,200, and moved on. You worked for 35 years. You told yourself you were going to travel the moment you retired. Italy, Greece, Portugal, the river cruise through France, business class both ways because your back cannot take coach anymore. You deserve it. You absolutely do. But here is what nobody tells you about retirement travel spending and taxes. The problem is not the trip. The problem is where the money comes from. Most retirees in their first year of retirement have not yet optimized their income sequencing. They are still pulling large chunks from the IRA because their Roth is small or non-existent, and their Social Security may not have started yet. Every large IRA withdrawal for discretionary spending stacks on top of their other income and creates a provisional income problem. A $28,000 European trip funded by IRA withdrawal on top of $70,000 in pension and Social Security income pushes a couple's provisional income to $107,000. That is solidly in the 85% Social Security taxation zone. It may clip the lowest IRMA threshold at $212,000 if combined with other income. And the marginal federal tax rate on that $28,000 withdrawal is 22%, meaning $6,160 of that vacation was paid to the IRS. The trip cost $28,000. The trip actually cost $34,160. This one is presented to retirees constantly as a smart financial move. Renovate now. Increase your home value. It is an investment. You will get it back when you sell. Here's the reality the real estate industry does not put in the brochure. The average kitchen renovation costs $68,000 in 2026, according to national remodeling data. The average return on that renovation at resale is 52 cents on the dollar. You spend $68,000, you recover approximately $35,360 when you sell. You permanently lost $32,640. But that is not the IRS part. Here's the IRS part. If you fund a $68,000 renovation with IRA money, which most retirees do because that is where the money is, you pay income tax on the withdrawal. At a blended effective rate of 19% for a typical middle-income retiree couple, that is $12,120 in federal income tax, plus potential IRMA, plus the provisional income spike making more Social Security taxable. The renovation you thought cost $68,000 actually cost $68,000 plus $12,120 in income tax, plus the lost compounding on $68,000 over 15 years at 5%, which is way $141,000. In future IRA wealth. You spent $141,000 in future wealth on something that added $35,360 to your home value. The IRS collected their portion silently and said nothing. The vacation home, the lake house, the mountain cabin, the Florida condo for winters. You have wanted it your entire adult life. And now in retirement, you finally have the time to actually use it. Here is what the vacation home actually costs in 2026 that nobody shows you at the closing table. The median vacation home purchase price nationally is $385,000. The carrying costs, property taxes, insurance, HOA fees, maintenance, utilities, average $18,400 per year. That is before a single mortgage payment if you financed it. If you financed it with a large IRA withdrawal for the down payment, you created the same IRMA and provisional income problems as the dream home purchase. If you rented out to offset the costs, you have now created a rental business with its own tax forms, depreciation schedules, passive activity rules, and potential self-employment complications. And here is the retirement-specific trap that catches everyone. The vacation home you bought at 64 becomes a problem at 74. Your mobility changes. The stairs become difficult, the driving distance feels longer, the maintenance you used to handle yourself now requires contractors, the carrying costs of $18,400 per year feel heavier on a fixed income than they did on the day you signed. And selling it creates a capital gains event on any appreciation, taxed at the federal level and potentially at the state level. The vacation home that felt like an upgrade at 64 becomes a financial and physical burden at 74 that costs more to exit than it costs to enter. The retirees who handle this correctly either rent vacation properties for the first 5 years of retirement, spending $12,000 to $15,000 a year on premium rental properties in the locations they love, with zero carrying costs, zero maintenance responsibility, zero capital gains exposure, and only purchase if the math still makes sense at 70. Or they never purchase and keep the $385,000 compounding inside a tax-advantaged account instead. Golf club, country club. Tennis club, the social structure of retirement for many people. And there is genuine value in the community, the activity, the social connection, all of which matter enormously for long-term health outcomes in retirement. But the financial structure of most private club memberships is a recurring tax trap that compounds quietly every year. The initiation fee for a mid-tier private golf club in 2026 averages $42,000. Annual dues average $1,400. That initiation fee, if pulled from the IRA, creates a $42,000 taxable event with all the provisional income consequences already described. And the $1,400 in annual dues, funded by IRA withdrawals over 20 years, cost not $1,400 per year in actual wealth, it costs approximately $24,000 per year when you account for the loss compounding on those withdrawals, $24,000 per year for 20 years in a private club, $480,000 in total wealth impact. The golf gets more expensive every year, the membership gets harder to exit, and the initiation fee you paid is typically non-refundable or only partially refundable at a significant discount. The retirees who love golf and manage this correctly join municipal courses with premier memberships at $2,400 to $4,800 per year. They fund it from Social Security or pension income, not IRA withdrawals. They play as much golf as the private club members. They spend $96,000 over 20 years instead of $480,000. That $384,000 difference stays in their IRA, keeps compounding, and becomes their grandchildren's inheritance. This is the upgrade nobody talks about in retirement tax planning videos because it feels wrong to put a dollar amount on generosity. But I am going to do it anyway because the IRS absolutely does. Retirees in their first 3 years of retirement, flush with the psychological relief of finally being done, feeling financially successful, wanting to share it, frequently increase their giving dramatically. Down payments for children's homes, or grandchildren's college funding, large charitable contributions, family vacations paid for by grandma and grandpa, cash gifts at Christmas that are 3 times what they were during the working years. None of this is wrong. All of it is generous and meaningful. But here is what it does to the tax picture. The 2026 annual gift tax exclusion is $19,000 per recipient. Gifts above that require filing a gift tax return, Form 709. They do not necessarily create a current tax bill, but they reduce your lifetime estate and gift tax exemption. And large gifts funded by IRA withdrawals create the same provisional income problems as every other upgrade on this list. A retiree who gives $50,000 to a child for a home down payment from the IRA has made a $50,000 taxable IRA withdrawal. The gift is not deductible. The income tax on the withdrawal is real. They gave $50,000 and kept approximately $39,000 after federal income tax. The child received $50,000. The IRS received $11,000. The retiree paid $11,000 to make a $50,000 gift. The alternative that actually works. Qualified charitable distributions, QCDs, allow retirees 71 and older to donate directly from the IRA to a qualifying charity, up to $108,000 per year in 2026, completely excluded from taxable income. The money never hits your adjusted gross income. It does not raise provisional income. It does not make more Social Security taxable. It does not trigger IRMA. A retiree in the 22% bracket who donates $30,000 to charity via QCD instead of taking the IRA withdrawal and then writing a check saves approximately $6,600 in federal income tax on that single transaction. The charity gets the same $30,000. The retiree's tax bill drops by $6,600. The IRS gets nothing. That is how giving in retirement is supposed to work. For family gifting, appreciated stock from a taxable brokerage account, not IRA cash, is almost always the more tax-efficient vehicle. You give the appreciated shares. The recipient gets a stepped-up cost basis opportunity depending on the situation. You avoid paying capital gains on the appreciation. The gift is the same size. The tax damage is dramatically smaller. This is the one. The upgrade that financial media, retirement publications, and honestly many well-meaning advisors present as the responsible, smart, correct move for every retiree. Hire a full-service wealth manager. Get professional management on your retirement accounts. Let someone qualified handle the complexity. I am not saying that advice is wrong. I am saying the way most retirees execute it creates a tax problem they never anticipated. Here's what typically happens. A retiree retires with $640,000 in a 401k. They roll it to an IRA. They hire a full-service wealth manager who charges 1% of assets under management annually. On $640,000, that is $6,400 per year in advisory fees. The fee itself is not the problem. 1% for genuine tax-aware, comprehensive retirement income planning is often worth it. Here is the problem. The wealth manager's primary tool for generating returns inside the IRA is active trading, buying and selling positions within the account. Every time they sell a position inside the traditional IRA at a gain, it is not a taxable event inside the account. That is fine. But when they rebalance, when they shift allocations, when they respond to market conditions, they are making decisions primarily based on investment return, not on your provisional income, not on your IRMA threshold, not on whether this year's withdrawal, combined with a Social Security adjustment and a pension COLA, is going to push you into a higher tax bracket. Most 1% AUM advisors are investment managers, not tax-integrated retirement income planners. The distinction costs retirees an average of $3,400 a year in unnecessary federal income tax, according to Vanguard's advisor Alpha Research, because nobody is coordinating the investment decisions with the tax decisions at the same time. The upgrade to professional management is correct. The mistake is hiring an investment manager when what you actually need is a retirement income planner who treats tax minimization as the primary mandate. Those are two different professionals. Most retirees never know the difference until they see a tax bill that surprises them. The question to ask any advisor before you hire them: show me how you coordinate my investment decisions with my provisional income calculation, my IRMA thresholds, and my Roth conversion strategy. If they cannot answer that question in specific concrete terms, they are an investment manager, not a retirement income planner. Keep looking. The One Big Beautiful Bill created the $6,000 senior bonus deduction for Americans 65 and older, with modified adjusted gross income under $75,000 single or $150,000 joint, $12,000 for couples where both spouses qualify. This is new. It did not exist before 2025. Here is how it interacts with the 8 upgrades. Every large IRA withdrawal for lifestyle upgrades risks pushing your MAGI above $150,000 joint, which disqualifies you from the $6,000 senior deduction entirely. One large withdrawal, one upgrade funded from the IRA at the wrong income level, gone. That is $12,000 in deductions you no longer get. At a 22% tax rate, that costs you $2,640 in additional federal income tax, on top of the tax on the withdrawal itself, on top of any IRMA surcharge. The SALT cap jumping from $10,000 to $4,400 changes the itemization math for retirees in high property tax states. If you are now able to itemize because SALT deductions make it worthwhile, some of the renovation costs I described may qualify as itemized deductions in specific circumstances. Run the numbers again. The math changed in 2026 in ways that are not obvious. And the tariff-driven market decline that hit retirement accounts this year creates a Roth conversion opportunity that directly reduces the long-term damage of every upgrade on this list. If your IRA is down 15 to 20% right now, converting a portion to Roth, at the lower balance, costs you less in income tax today. It reduces future RMDs. It reduces future provisional income. It reduces future IRMA exposure. It permanently reduces the lifetime tax damage of every upgrade you make from this account. The retirees executing Roth conversions right now, while markets are down, while the new senior deduction gives them additional room, are making their future tax bill smaller permanently. The retirees rushing into lifestyle upgrades funded by large IRA withdrawals right now are doing the opposite. Here's the playbook for retirees who want the upgrades without the tax destruction. Year 1 and 2 of retirement. Make no large IRA withdrawals. Use this window to execute Roth conversions while your income is at its lowest. Before Social Security starts, before pension COLAs compound, fill the 12% and 22% brackets deliberately with Roth conversions. Reduce the traditional IRA balance in a controlled, tax-efficient way. Fund lifestyle upgrades from the right accounts in the right order. Roth IRA first, completely tax-free, no provisional income impact. Taxable brokerage accounts second. Capital gains rates are lower than ordinary income rates, and you can harvest losses to offset gains. Traditional IRA last, and only in amounts that keep your provisional income below critical thresholds. Time large one-time expenditures to low-income years. The year before a pension COLA, the year before Social Security starts. A year with large medical deductions that offset the withdrawal. A year with large charitable contributions that reduce MAGI. Every large purchase has an optimal tax year. Finding that year before you spend the money is worth thousands of dollars. Keep upgrades below the IRMA cliff. In 2026, a married couple crossing $212,000 in MAGI triggers the first IRMA surcharge. That is a hard cliff. Spending $50,000 in IRA withdrawals that pushes you from $198,000 to $213,000 costs you $1,176 in Medicare surcharges the following year. One phone call to a tax planner before making that withdrawal saves $1,776. every time. Use QCDs for all charitable giving after age 71 to 2. Every dollar of charitable giving that goes through a QCD instead of a personal check is a dollar that never raises your provisional income, never makes more Social Security taxable, and never triggers IRMA. This is the single most underused tool in retirement tax planning. Most retirees who give to charity have never heard of it.